Welcome back to Simply Money. Today we're going to be looking at SOXX, SOXX, an iShares ETF focused on semiconductors. We're going to look at how it would have performed if you put in $50,000 back in March of 2017. We've done some other videos similar to this where we looked at JEPQ and SCHD, and as promised, now we're going to look at this incredible growth ETF, SOXX. It is comprised of 30 companies that focus on semiconductors, a big element in AI production. First, I want to share a little bit about this ETF. We're going to look here. You can see that it is 100% comprised in the technology field. So your diversification and sector weighting is all technology. Again, this is for educational purposes, for entertainment purposes. This is not a recommendation to buy or not buy SOXX, but it is information sharing how it has performed in the past, and a little bit about the ETF. If you're looking to invest, you need to do your own homework, your due diligence, and make sure that it aligns to your goals. But if you're looking to diversify and add a little bit of growth, or maybe you're looking for spending a little bit of money on a side investment where you can put a little bit of money in something that has a lot of upside, this is one, as you'll see, has performed extremely well. The top 10 holdings make up almost 61% of the 30. NVIDIA is the largest holding at 10.5. Advanced Micro Devices, Broadcom, Qualcomm. You can see these are very well-known semiconductor companies. They do other things, but their production of semiconductors is a huge element in why they're growing. So we're going to continue on. We're going to look at our scenario that we've looked at in other videos. If you want to see about SCHD, check out the link. If you want to check out JEPQ, check out that link. And you can watch these videos and how these have performed over the last 7 years. JEPQ, we don't have a full 7 years because it hasn't been around that long. But now we're going to look at SOXX. So let's take a look at this. We'll go to our screen that we've been sharing, similar screen, where we show that we bought the ticker SOXX on March 1st, 2017. We paid $50,000. The price at the time was $44.35 per share. That gave us 1,127 shares, and that allows us, again, that $50,000. So we scroll down here, you'll see our first dividend payment. This is not a dividend stock, as you can see here, that the yield on this is 0.69. So keep that in mind, how small of a yield this is. And we're going to look at how this has performed over the last 7 years. On the 24th of March, we get our first dividend, 35 cents per share. Because we had 1,127 shares, that payout is $394.59. The stock price has only gone up a few cents since the beginning of the month. So with that dividend, we were able to buy almost 9 more shares, adding to our cumulative quantity of shares and our total value of the portfolio. We'll skip down to the end of that year. We have dividends in June, September, and December. Again, SOXX is a quarterly dividend payment. You can see the dividend per share was 36 cents, 50 cents, and 32 cents. For your first year, that's what your annual payment would have been per share. That allowed payments of $409, $572, and $369. Again, the stock price has gone up on each of these quarters. So we're up to $58 per share here at the end of the year. And you can see the number of shares you can buy with those dividend payments each quarter. So now our total quantity has gone up to 1,162 shares, and our value to $67,700. Not bad for 1 year, going up almost $18,000 in 1 year. And getting dividend payments about $1,700. So you're looking at a nice return as well as receiving some dividends if you were not to reinvest this. Now in these scenarios we've been doing, we're doing dividend reinvestment. We've set the DRIP, dividend reinvestment plan, to on. So anytime it receives a dividend, it automatically buys more of the same shares. That is part of the dividend snowball growth method that we're using. Now, if you want to look at this as far as how much you could generate in income. Say you were looking to supplement your income and you owned a large number of these stocks. How much income could that generate for you? But we're looking at growth. We're in the growing our portfolio phase. We're not living off of it in these scenarios. So we made a $50,000 investment. In our first year, we've gone up almost $18,000. Now let's skip down here to the end of 2019. As you can see, the dividend payments continue to increase. There's some nice increases here. We're in September of 18, you get 82 cents. Look at this, September of 19, you get 96 cents. And then December, 86 cents, where you get an $1,100, $1,000 payments. Look at that just from year one to the third year, going from $394 in March to $630 in that year. Look at December, $369 going up to $1,000. That is a nice yield on cost. You didn't invest any more than that $50,000, but now you're generating each year $6,700, give or take here in this 4-quarter periods. That is nice. You're also looking at your appreciation. Look at the value of this stock, this ETF, $63, dropped a little bit here, $61, then it shoots up to $69. Then the end of the year, you're at $82. So you're able to buy, look at all the shares you've been able to buy with the drip being turned on. And then you come over here, end of the year, at the end of your third year, you have doubled your money. The rule of 72 is you take 72 and divide it by the interest rate that you're getting each year, and that's how long it will take you to double your money. So you divide 72 by this interest rate, and you see it only took 3 years to more than double your money. That is an incredible return. This SOXX has been on a tear. Now, I'm not telling you to buy this just because it's been up, because we're going to look now at 2020, COVID, March, dividends 70 cents. Your dividend payment still $887, but look at that, you drop down to $68. Again, remember COVID, everyone was panicking. The stock market plummeted for a few months. It was panic. Everybody just had this fear. Fear drives sell-offs. And that is the time that you should look at investing. Because look how much lower this was from when you just reinvested your dividends the period before. $68. It's on sale. You're able with that dividend to get 13 more shares. And now you're up to 1,280 shares. But look, this is where people freak out. In December, you're looking, oh, I'm doing great. I'm such a good investor. I'm so smart. $104,000. I've more than doubled my $50,000 investment. And then this type of stuff hits the stock market. COVID, housing bubbles, .coms, inflation, different things, all sorts of things wreak havoc upon the stock market. People get fearful. They start selling. The market drops. It is normal. It was a big drop. And so people look here and say, oh my gosh, I've lost all my money. You'll hear people say that. They went from 104 down to 87. I've lost all my money in the stock market. No, you have not. You invested $50,000. You're looking at this drop, but you are up $37,000 still. But because you were so excited back here, you feel like you're set back, you're freaking out, and that's how things go. You freak out, you sell. And this is where a lot of people would start selling. But watch what happens if you freaked out here during COVID. If you have a long-term investment strategy, you are buying and holding for the long term, not the ups, not the downs, long term. What is your goal? To be financially independent, whether it's FIRE, retirement early, whether it's retire at a normal 62, 65, 70, whatever it is, the time frame you've set that you want to plan on looking to withdraw and use these funds, that's when you should be looking at, okay, should I be diversifying, going into more conservative investments? You have to have your plan individually. Remember, investments, financial planning is individual. There is not a one-size-fits-all. I could give you a whole plan on here. You could listen to all sorts of financial influencers on YouTube and different people. They're going to tell you different things. But the point is, all of these things can be good information for you to help digest and learn what your plan needs to be for you and your family. It's individual. This is just educational stuff for you to look at and to learn, not to say, oh, I'm going to do this. And you should not do that with anyone. Even a financial advisor that you pay and go and sit down with, they shouldn't make your financial plan. They should educate you on helping you decide your financial plan. You are the one in control of your money, and you should be the one that makes that decision. Let's look what happens. Let's pretend right here you freaked out, you sold. Still up $37,000. That's fine. There's nothing to be ashamed about on that. That's a great thing. You're up 37 grand, you sold. Okay. You walked away with $37,000. But if you had just sat and held to your guns, let's look at June. Look at this. Price is already in June back up higher than ever, the highest it's ever been. Now look at your portfolio. You not only sold here after it had dropped because you didn't time the market, because you can't time the market. It's not about timing the market. It is about time in the market. And you didn't time it to sell here at this high. You freaked out and sold here. Now look, 3 months later, it would have been above another $11,000 where the high that you were so excited about before was. And that's where you can't allow your emotions to drive your investment decisions. Your investment decisions need to be based on the facts that you have set aside and planned out accordingly. Let's look at the end of 2020. We go down 2 more quarters and see these dividend payments. Those are looking rather nice. $1.07 per share gives you $1,300. Look at this price, $95, $125. You're buying more shares with your dividend, and look where you're at. If you sold in March, you freaked out during COVID. If you had waited till December, almost twice as much, just 9 months later, by not panicking. Again, hey, you're up $37,000 here. You sold and you put it into some T-bonds or CDs or savings account because you were afraid you were losing all your money. But if you sat tight, waited, let all the panic settle, you would have doubled your money again. Now look, 4 years after you initially put in $50,000, you have more than tripled your money. But so many people would have bailed right here because they're afraid. So we're going to skip down. Let's go scroll down all the way here to 2023. So now it's the end of 7 years. We'll go look back here at the end of COVID, 75 cents on your dividend. You can see these dividends have been growing. Look at that, all the way up to $1.80, $1.67, $1.12. Look at the size of this dividend on your last year. This is your 7th year in this ETF. Look at this dividend, $1,400, 3 months later, $900, 3 months later, $2,300. This is on a $50,000 investment. The yield on cost on that is incredible. Look at your stock prices. We've got a nice high here of 125. You can see it goes to 172, 182, or 181. Drops down again. People start panicking. Oh no, it's going to 161. Oh, 132. Oh no, 110. 2022 was a rough year. COVID was short. Riding that one out was a lot easier. It only lasted a short period, then it started rising again. 2022 is a little bit longer. It lasted. People started freaking out. Okay, maybe you held on into March. No, June, it's really dying. Oh, September 110, I'm selling. I can't handle it. So you're down to 152. Again, tripled your money from your investment. Nothing to be ashamed of. But you freaked out. You panicked because the stock market is up and down. Now the beta, that means the fluctuation of this compared to the S&P 500 is a 1.61. That means it has a much higher high, but a much lower low. So when it drops hard. But when it rises, as we've seen so far, it rises fast. This type of investment, you have to be able to ride the roller coaster. It's like you going to Six Flags and you love the excitement, but you want roller coasters that only go up. Well, guess what? That's not how life works, and that's not how roller coasters work. And that's definitely not how the stock market works. If you're going to go up, you're going to come down. The higher you go up, the higher the downs. So that is the stock market. You have to be able to ride those exciting highs along with those scary lows. Here at end of 2022, it starts picking up. So, okay, we got some of our money back, but look at this. When it was low, you were able to buy 22 more shares with this massive dividend that was paid. Now you've accumulated so many more shares of this ETF. It starts climbing back up. 2023, it was doing really well. It started climbing, dropped a little bit, and then the end of 2023, it has taken off. Look at that, $188. And I'm going to scroll down here. Don't get confused by this dividend. I'll share this in a minute. $224. What happened between here and here was a 3-to-1 split. So if you owned, and I didn't factor that in here, if you owned this, you now own 3 times as many. But I wanted to show you the increase of the value of the share, $224 per share. You're now up to 1,400 shares. And look at that, $320,000. 7 years later, off a $50,000 investment. But you had some scary moments. You had that COVID scare. Did you sell? You had this 2022 scare. Did you sell? Because if you did, look, tripled your money. Great job. 50,000 to 152. I'll take that any day. But if my plan was to buy and hold this ETF long term, look what I missed out. Another doubling of the share because panic, fear. Oh no, I'm going to lose all my money. Why would I panic here? I'm still up threefold on my money. I have still tripled my investment in 5 years, but I panicked. I freaked out. But if I held to my plan, look, $320,000. Let's scroll down real quick at the end here. That is your dividend payments over the course of this testing. You've accumulated $29,000 in dividends. Your share price growth, 405% growth. You've gained 301 shares by reinvesting the dividend. Instead of taking the dividend and spending it, you've accumulated 300 more shares, bringing your total up to 1,400. And your value gained, look at that, incredible gain, $269,000 of value gain. Now, you haven't got any of that because it's still not realized gains. It's still sitting there. It could drop tomorrow. That could go down to 100,000. Let's look at this chart. I threw a chart in this time to help because this one is very, what I'll call volatile. Look at that fast growth. Just boom. I mean, that just took off. Here, this is, good growth. I'll take this any day. Oh, there's that pesky COVID. See how short that was, though? It dropped, boom, shot right back up, and then just climbed and climbed. 2022, everything went down. This one went down much faster because it went much faster. We rode it out. We handled it. We dealt with it. I want to look at this. Look how much higher I am than here. 50,000, 152,000. But then, bam, it took off again. Had a little dip there. That's going to happen. If we were to run this over any stock, any ETF over 20, 30 years, you would just see a wave, big little dips and bumps. That is the stock market. It is not a linear line straight up. That is not how it works. This is where people sell and panic. This here is where everyone's like, I'm getting out. I'm done. I can't handle it. And this is what you miss. So again, this is not recommendation to go buy SOXX. It's comparing this ETF to the other ETF. Like again, check out SCHD's performance, but it's a totally different ETF. That is a dividend growth ETF. It's not a growth ETF. This is strictly a growth ETF, 100% technology, where SCHD is diversified in all the different sectors with 100 different stocks, where this only has 30 stocks. We're going to look at another one, SPY, which is the S&P 500, which is 500 stocks, which is going to diversify even more. So you have to know why you're buying certain ETFs and what the performance will be and handle the ups and downs. I am excited to share with you this and other videos on different ticker symbols. If you have a ticker symbol you want to learn about, an ETF or single stock you want to do a comparison, a test on, throw a comment down below. Let me know which one you want to compare to. And that is it for this video. Thank you for joining me on Simply Money. I hope you find these videos entertaining and informative. If you do, hit the like button, subscribe, and don't forget to be notified for when the next ETF backtest comes out so you can see, is it the one that I want to see how it's performed? We'll see you next time on Simply Money.